My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by Osmania University, Palamuru University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 5 first important short question is Corporate restructuring. Corporate restructuring means making big changes in a company's structure to improve its performance and profits. It can involve changing ownership, merging with another company, selling a part of the business, reducing debt, or changing the business model. The main goal is to make the company stronger, more profitable, and ready for future growth. Types of restructuring. Merger or acquisition, joining with or buying another company. Divestment, selling a part of the business. Debt restructuring, changing loan terms to reduce pressure. Internal restructuring, changing departments, roles, or staff. Example. When Vodafone India merged with Idea Cellular, it was a form of corporate restructuring to face competition from Reliance Jio. Corporate restructuring is like fixing and upgrading a vehicle. It helps the company run smoother and faster in the business world. Next important short question is 2. Corporate governance. Corporate governance means rules, practices, and processes used to manage and control a company properly. It ensures that the company works fairly, transparently, and in the interest of all shareholders, employees, customers, and society. It is about making sure the company is run responsibly and no one misuses power or money. Key elements. Board of Directors guides and monitors the company. Audit committees keeps a check on financial reports. Transparency, clear communication with stakeholders. Accountability, company leaders are responsible for their actions. Example. Infosys, a major Indian IT company, is well known for strong corporate governance. It always publishes clean financial statements and respects minority shareholders. Good corporate governance builds trust, attracts investors, and avoids scams or fraud. It is like having strong brakes in a car. It keeps the company safe on the road of business. Next important short question is 3. Corporate mergers, reasons. A corporate merger means two companies join together to form a single company. Companies do this to grow bigger, reduce costs, and compete better in the market. Main reasons for mergers. 1. Growth and expansion. Mergers help companies enter new markets or offer new products. 2. Cost savings. Combined operations lead to economies of scale, reducing expenses. 3. Increased market share. A merger helps beat the competition and capture a larger market. 4. Tax benefits. Sometimes, one company with losses merges with another to get tax savings. 5. Synergy. When two companies work better together than separately, it is called synergy. Example. In India, Vodafone and Idea merged to form 6, Vodafone Idea, to survive tough competition and reduce losses. In short, mergers help companies become stronger, more profitable, and more competitive, just like two friends joining hands to win a race. Next important short question is 4. Acquisitions and takeovers, reasons. An acquisition or takeover happens when one company buys another company and takes control over it. It can be friendly or hostile. Main reasons. 1. Growth. Companies acquire others to enter new markets or expand faster. 2. Eliminate competition. Taking over a rival reduces market competition. 3. Technology or talent. Sometimes companies buy others for their advanced technology or skilled workforce. 4. Diversification. Firms acquire businesses in other industries to reduce risk. 5. Undervalued companies. If a company's share price is low, others may buy it at a cheap rate. Example. In 2007, Tata Steel acquired Corus, a UK steel company, to become one of the world's largest steel producers. In short, acquisitions help companies become more powerful, profitable, and global, like a smart player adding strong teammates to win the match. Next important short question is: 5 motives for mergers. A merger happens when two companies join together to form one larger company. The main motive is to create more value together than as separate companies. Key motives: 1. Synergy. The combined company performs better by saving costs or increasing profits. 2. Market expansion. Entering new markets or gaining more customers. 3. Cost reduction. Merging helps reduce duplicate operations and cut costs. 4. Tax benefits. A profitable company may merge with a loss-making firm to reduce tax burden. 5. Survival. Weak companies may merge to stay alive in tough times. 6. Growth. Faster business growth without starting from scratch. Example. In 2002, ICICI merged with ICICI Bank, making it a stronger player in the banking sector. Mergers are like teamwork in cricket. When players combine skills, the team wins better than individual efforts. Next unit 5. Long questions. First important long question is: 1. Types of mergers with examples. A merger is when two or more companies come together to form a single company. There are different types of mergers based on the nature of businesses involved. 1. Horizontal merger. This merger takes place between two companies in the same industry and at the same level of production. Purpose: to reduce competition and gain market share. Example: Vodafone India and Idea Cellular merged in 2018 to become Vodafone Idea, reducing competition in the telecom sector. 2. Vertical merger. Happens between companies in the same industry but at different stages of production or supply chain. Purpose: to improve supply chain efficiency and reduce costs. Example: a car company merging with a tire manufacturing company. 3. Conglomerate merger. Takes place between companies in completely unrelated businesses. Purpose: to reduce business risk by diversification. Example: Tata Group, which operates in steel, cars, tea, and IT services, has used conglomerate strategies. 4. Congeneric merger, also called product extension merger. Happens between companies that serve the same customers but offer different products. Purpose: to expand product range and serve existing customers better. Example: a mobile company merging with a mobile accessory company. 5. Reverse merger. When a private company merges with a public company to become listed without going for an IPO. Example: Godrej Soaps Limited merged with Gujarat Godrej Innovative Chemicals Ltd. Easy tip to remember. Think of it like food. Horizontal is equal to same dishes. Vertical is equal to ingredients plus cooking process. Conglomerate is equal to different dishes on one plate. Congeneric is equal to similar meals, like pizza plus garlic bread. Reverse is equal to small cafe joining a big restaurant chain to go global. Next important long question is: 2. Explain the economic rationale of mergers. Economic rationale of mergers. Mergers happen when two or more companies join together to become a stronger single company. The main economic reason behind mergers is to improve performance, reduce costs, and increase profits. Let's look at it in a simple way. 1. Economies of scale. When two companies merge, they can produce more at a lower cost. Bulk buying of raw materials and shared resources leads to cost savings. Example, a detergent company and a packaging company merge and reduce packaging costs. 2. Increase in market share. Mergers help companies become larger and more powerful in the market. This means more customers and better bargaining power. Example, Vodafone and Idea merged to compete better with Jio in India's telecom market. 3. Access to new technology or products. A merger can bring new technology, skills, or products that one company didn't have before. Example, a traditional bank merging with a fintech company to improve digital banking services. 4. Tax benefits. Sometimes, a company with losses can merge with a profit-making company to reduce overall tax liability. Example, a loss-making firm merging with a profit-making firm can use the past losses to save on taxes. 5. Synergy. This means that 2 plus 2 equals 5, the merged company is more valuable than the two separate companies. They can work better together than apart. Example, a delivery service merging with an e-commerce company creates faster delivery and better customer service. 6. Survival and competition. Some companies merge just to survive tough competition or to avoid going out of business. Example, small airlines merging to compete with big players like Indigo. Easy way to remember missed cent. M. Market share. I. Innovation technology. S. Synergy. T. Tax benefits. S. Survival. T. Total cost savings, economies of scale. Next important long question is 3. Financial evaluation of mergers. Financial evaluation of mergers means checking whether a merger will be beneficial or not, mainly in terms of profits, value, and future growth. Before two companies merge, experts use financial tools and data to decide if the deal is good for shareholders. 1. Valuation of companies. The first step is to calculate the value of both the acquiring company and the target company. This can be done using discounted cash flow, DCF, method. Future cash flows are estimated and discounted to present value. Comparable company analysis, compare with similar companies in the market. Example, if company A wants to merge with company B, it will calculate how much B is worth using DCF or market multiples, like PE ratio. 2. Exchange ratio. If shares are exchanged, then the companies must decide how many shares of the acquiring company will be given for one share of the target company. This is called the exchange ratio. Example, if one share of B is equal to 2 shares of A, then for every 100 shares, B's shareholders get 200 shares of A. 3. Impact on earnings per share, EPS. After the merger, we check whether the EPS of the new merged company increases or decreases. If EPS increases, it's a good sign, accretive merger. If EPS decreases, it may be a concern, dilutive merger. 4. Shareholder value creation. Will shareholders benefit? The increase in share price or better returns after merger tells us if value is created. 5. Cost of merger and synergy benefits. The total cost of the merger is compared with expected benefits, synergies. If benefits cost, the merger is financially good. Easy tip to remember: VESC. V. Valuation. E. Exchange ratio. E. EPS impact. S. Shareholder value. C. Cost versus synergy. Next important long question is 4 approaches for valuation, DCF approach and comparable company approach, no practical exercises. What is valuation? Valuation means finding the worth or value of a company. When companies go for mergers, acquisitions, or selling, they must know how much the company is worth. There are 2 main approaches used for this. 1. DCF approach, discounted cash flow. Meaning, this method calculates the present value of future cash flows a company is expected to earn. It assumes money today is more valuable than money tomorrow. Steps. Estimate the future cash flows for the next few years. Choose a discount rate, usually WACC, weighted average cost of capital. Discount the future cash flows to today's value. Example. If a company expects to earn 5 lakhs rupees every year for 5 years, and we use a 10% discount rate, the DCF approach will calculate the total worth today based on that. Easy to remember. DCF is equal to future profit discount present value. 2. Comparable company approach. Meaning, this method compares the company with other similar companies in the same industry which are already listed or sold. It uses market ratios like PE, price to earnings, EV/EBITDA, etc. Steps. Find a few similar companies. Take their financial ratios. Apply those ratios to your company to estimate its value. Example. If similar IT companies are trading at a PE ratio of 15 and your company has an EPS, earnings per share, of 20 rupees, then its value is equal to 15 times 20 is equal to 300 rupees. Easy to remember. Comparable is equal to compare with others, use ratios, estimate value. Summary table. Approach key idea used when DCF future cash flows, discounting if cash flows are stable and predictable. Comparable company compare with similar firms when market data of peer firms is available. Final tip. Remember, DCF is equal to future focus and comparable is equal to market mirror. Next important long question is 5. Corporate value-based management systems. What is value-based management, VBM? Value-based management, VBM, is a system where a company's decisions, strategies, and goals are focused on increasing the value of the company mainly for shareholders, owners. It helps managers think and act like owners, aiming to increase the company's overall worth, not just short-term profits. Why is VBM important? It ensures better decision-making at every level, from top managers to workers. Focuses on long-term value, not just quarterly results. Helps in aligning employees' efforts with shareholder wealth. Key features of VBM. 1. Focus on value creation. Every business activity should lead to increasing the value of the company. 2. Performance measures. VBM uses special financial tools like EVA, economic value added, and MVA, market value added, to measure whether the company is creating value. 3. Decision-making tool. VBM helps in deciding which projects to take, what products to launch, and how to use company funds. Example. Let's say ABC Textiles Limited wants to launch a new product line. Under traditional management, they might check profits only. Under VBM, they will check whether the project will increase the overall company value in the long term. If the new line gives high returns above the cost of capital, then it's adding value. If not, it's rejected, even if it's profitable in the short run. Easy to remember trick. VBM is equal to value before money. Always focus on increasing long-term value, not just earning quick profits. Conclusion. Value-based management is like a compass that guides the company towards long-term wealth creation, making sure that every step taken adds to shareholder value. It transforms management from just running the business to growing the business value. Next important long question is 6 approaches, Marakon and McKinsey. Introduction. In value-based management, VBM, two popular methods used to increase company value are the Marakon approach and the McKinsey approach. These help companies to focus on increasing shareholder wealth, not just profits. 1. Marakon approach. The Marakon model is based on the difference between a firm's return on equity, ROE, and its cost of equity, K. Key idea. If ROE company is creating value. Steps in Marakon model. 1. Find ROE, return earned on shareholder funds. 2. Find K, minimum return expected by investors. 3. If ROE is more than K, it means value is being created. 4. The company must improve sales growth, profit margins, asset efficiency. Example. If ROE is equal to 18% and K is equal to 12%, the company is creating 6% extra value for shareholders. 2. McKinsey approach. This approach is broader and helps in understanding what drives value in a company. Key concepts. 1. Value drivers. Sales growth, profit margins, capital efficiency, etc. 2. Spread, difference between ROC, return on invested capital, and WACC, weighted average cost of capital. If ROC WACC value is created. 3. Future value creation, focus on long-term sustainability. Example. If ROC is equal to 14% and WACC is equal to 10%, the company is earning 4% more than the capital cost. Good value creation. Memory tip. Marakon is equal to ROE versus K. McKinsey is equal to ROC versus WACC plus value drivers. Conclusion. Both approaches help companies measure and improve their value creation. Marakon is more focused on equity returns, while McKinsey is more strategic and holistic. Indian companies can use these models to plan mergers, improve operations, and increase long-term wealth. Next important long question is 7. Principles of good corporate governance. Principles of good corporate governance. Introduction. Corporate governance means the way a company is directed, controlled, and managed. Good governance builds trust, transparency, and long-term success in business. It protects the interests of shareholders, employees, customers, and society. Main principles of good corporate governance. 1. Transparency. The company must clearly share important information like financial performance, risks, and policies. Example, Infosys shares detailed quarterly results on its website. 2. Accountability. Management is answerable to the board, and the board is answerable to shareholders. If anything goes wrong, they must take responsibility. 3. Fairness. Treat all stakeholders equally, including small investors, employees, and customers. No special advantage should be given to big shareholders. 4. Responsibility. The board of directors should take sound and ethical decisions that help in long-term success. They should avoid decisions that may harm the environment or public trust. 5. Independence. The board should include independent directors who are not influenced by promoters or management. These directors help in unbiased decisions. 6. Compliance with laws. The company must follow all rules and regulations like SEBI rules, Companies Act, etc. Example, Tata Group companies strictly follow legal norms and ethical codes. Conclusion. Good corporate governance is like the steering wheel of a company. It guides the company towards ethical success and builds investor confidence. In India, companies like Infosys, TCS, and HDFC Bank are examples of well-governed firms. Memory tip T.A.F.R.I.C. Transparency, accountability, fairness, responsibility, independence, compliance. This makes it easy to remember during exams.